Hello everyone, welcome back. So in this video, we will be exploring the most popular combination strategies that includes long and short straddle and strangle. So long straddle strategy works well when you're expecting a big move in the stock price, but you're not sure which direction the move will be. For example, if the union election results are coming, the market could rise sharply if the current government stays in power or drop significantly if the opposition wins. So either way, you expect high volatility, but don't know whether the market will go up or down. So, what combination of options would you use to make the most out of this situation? So, you buy an ATM call option because you expect that the market might rise from the current level, and also buy an ATM put option because you think the market might fall from the current level. If the market goes up, you can exercise the call option and let the put option lapse. If the market drops, you can exercise the put option and let the call option lapse. Now, let's check the option chain to find the current spot price and the premiums for the ATM call and put options. So currently, Nifty index is at 23,862 points. Let us buy a 23,850 call and put option. The premium for 23,850 strike price for call option is rupees 178 and the premium for 23,850 put option is rupees 127. The total cost of the strategy is a net premium paid, that is a call premium plus the put premium, which is 178 plus 127 gives us 305. Now let us discuss about the profit or loss on the expiry date with various market situations. Let's start with the call option. In case on the expiry date, if Nifty closed at rupees 23,150 points, the profit or loss for the call option can be calculated using the formula maximum of spot price minus strike price, 0 minus the premium per share. So here we get a loss of rupees 178. Now, let us compute the profit or loss for the put option using the formula. Maximum of strike price minus spot price, 0 minus the premium per share. So here we get a profit of rupees 573. So the combined net profit or loss is negative 178 plus 573 gives us 395 rupees. Now, drag the formula to the rest of the cells. Before that, don't forget to log the cells containing the strike price and the premium. Let's now draw the payoff graph by selecting the spot on expiry and the total profit or loss and choose the scatter plot. Now, let us discuss the maximum profit. The best part of a long straddle is that there is no limit to how much profit you can make. If the stock price moves very high or very low, beyond a certain point, your profits can keep growing because you have got both the call and put options working in your favor. So, if the price shoots up, your call option will make money. If the price crashes, your put option will make money. So that's the power of this strategy. Now let's move on to the maximum loss. Here is where you need to be a bit careful. So the maximum loss happens when the stock price stays close to the strike price at expiry, basically when there is no big move. In that case, both your call and put options will lose value. In this example, your maximum loss is rupees 305, which is the combined cost of the call and put premium. Now let's move on to the break-even point. So here there are two break-even points in a straddle strategy, one on the higher side and one on the lower side. So to calculate the upper break-even point, you take the strike price and add the net premium. Here it is 23,850 plus 305, which gives us 24,155. For the lower break-even, you take the strike price and subtract the net premium. So it is 23,850 minus 305, which gives us 23,545. So if the stock price stays within this range, you're making a loss. But the moment it moves outside this range, you start making profit. So, in short, this strategy is great for times when you expect a big event or a news that might cause a significant price change. Hope that makes sense. Now, let us move on to the short straddle strategy. A short straddle is like the opposite of a long straddle. Here, instead of buying both a call and put option, you sell both the ATM call and ATM put option with the same strike price and expiry. Why would someone do this? Well, it's for traders who believe that the stock price will stay close to the current level and won't move much until the option expires. In other words, this strategy works best when there is low volatility in the market. Now let us compute the profit or loss for this strategy considering various market situations on the expiry date. In case the Nifty index is at 23,150 on expiry date, let us begin with computing the profit or loss for the short call option. So here we use a formula premium per share minus maximum of 0 or spot minus strike price. So here we get a profit of rupees 178. Now let us move on to compute the profit or loss for the short put option. We use a formula premium per share minus maximum of 0 or strike price minus a spot price. So here we get a loss of 573 rupees. So the combined net profit or loss is rupees negative 395. Now drag the formula to the rest of the cells. But before that, you make sure that you lock the cells containing the premium and the strike price. Let us also draw the payoff graph by selecting the spot price and expiry and the total profit or loss by choosing the scatter plot. So in a short straddle, your maximum profit happens when the stock price at expiry is exactly equal to the strike price of the options you sold. In this case, the strike price is 23,850. So why does this give you the most profit? Because at this point, both the call option and the put option you sold will expire worthless. When this happens, you get to keep the entire premium you collected upfront. Here, the premium received is rupees 305, which is your maximum profit. So it's like taking a bet that the stock won't move much, and if it doesn't, you pocket the premium without any worries. Now, let's talk about the risk. So the maximum loss in a short straddle is unlimited. So this is a risky part of this strategy because the stock price can move sharply in either direction, up or down. So if the price shoots up, the call option you sold will start losing money. On the other hand, if the price crashes, the put option will lose money. Since you are the seller in both the cases, you are responsible for covering those losses. And this is why this strategy is considered very risky. You're essentially betting against the big movements in the stock market. Coming to the break even points, there are two important levels where your profits turn into losses. These are called the upper and lower break even points. The upper break even point is calculated by adding the net premium received to the strike price, which in case is 23,850 plus 305 gives us 24,155. The lower break-even point is a strike price minus a net premium. So 23,850 minus 305 gives us 23,545. So if the stock price at expiry stays within this range of 23,445 to 24,155, you will make a profit. But if the price moves outside this range, your losses starts piling up. So to sum it up, a short straddle can give you a steady profit if the market stays calm and the price doesn't move much. But it's a risky strategy because any big move can lead to unlimited losses. So, this strategy works best when you're confident that the stock price will remain stable and volatility will stay low. Now, let us now move on to a strangle strategy. In a strangle, the call and put options have different strike prices, and both are usually out of the money. This means the call strike price is slightly above the current market price, and the put strike price is slightly below it. A strangle also works when you expect a big price movement, but since you're buying an OTM option, the upfront cost of the premium is lower than the straddle strategy. However, for the strangle to be profitable, the stock price must move more significantly when compared to the straddle strategy. A strangle is a cheaper strategy but requires a price to move a lot more to make more money. Both are great strategies for uncertain markets where you expect volatility. So, we have explored the difference between the straddle and strangle strategies and how they can cater to different levels of expected market movements. As always, understanding the market scenario and your risk appetite is a key when choosing the right strategy. So, options trading is a powerful tool, but it requires careful planning and clarity. So, I hope this session has given you a solid understanding to approach these strategies confidently. So, thank you for watching. See you in the next video.